All right, good afternoon and welcome. It's good to see a full room here today. We're very privileged to have with us today Professor Harry C. Veryser. Professor Veryser was the chair of the Department of Economics and Finance at Walton College for 20 years, 1987 to 2007, at which time he went to the University of Detroit Mercy and took over as chair of the Econ and Finance Department there. For several decades, he and his family owned a stamping company serving the auto industry in Detroit. He is a past recipient of the Will Herberg Award, which recognizes the top educators in the country. He's served in a variety of capacities in both the private and the nonprofit sector throughout his career. He's one of the leading authorities today in the world of Austrian economics, and you'll get a taste of that in terms of the topic that he'll be addressing, monetary policy in the era of COVID. There are a lot of things that I can say in testament to Harry's professional accomplishments and who he is as a person, but I'll just simply say this, that I'm a better person today because of the relationship I've been fortunate to have with him. And I can tell you to a person, anybody who's known him for any period of their time has learned more about what it means to be a human person simply by being associated with Harry. And there's a depth and a breadth to that I won't go in today. You know my tendency to go on the long segue, so I won't. But without further ado, let's give Professor Harry Veryser.
Okay, Mike, thanks a lot. It's nice to come here to Aquinas College. St. Thomas Aquinas is what I consider one of my patron saints. Always have loved reading them. And St. Augustine's a little bit more human. Thomas is like a geometry book sometimes, but Augustine has more of the humaneness to him, or he'll tell you more about what's going on in Rome and or in where he was. And I use quite a bit of his stuff on the division of labor in my book, so on St. Augustine. But Thomas is this really the structure of it, the Aristotelian structure. What I want to talk about, I think, is the economy today. And it's, I can tell you that every time I see a doctor, the first question they ask is, what's going on in the economy? I just lost $250,000. Okay. Now, obviously, these doctors have more money than that, but I take some severe losses. And they always ask me, what should I invest in? Well, I'm not an investment advisor, so I don't get into that. But from my viewpoint, I think we're going through the cycle. And remember, there's a difference between a bubble and a cycle. Okay. A bubble, everybody gets excited about something, and they're all, let's buy this stock, or let's buy the tulip bulbs. I don't know you know the story of the tulip bulbs. But what happens is you get a lot of credit, people get all excited, they go over leverage. And what they do is, like in Florida in 2008. Okay? Well, 2008, everybody was buying condos. 16,000 condos were sitting in Florida. Nobody was living in them, and they were trying to sell them to somebody else. And of course, what happens in the bubble, when you start selling, everybody thinks, oh, there's no top. And then when people start to sell, the price starts dropping, and then everybody says, I'll buy tomorrow, because the price will be lower. And it goes down, well, I'll buy tomorrow, and then the bubble ends. And I think we've had a bubble to some extent in the social media stuff. I think a lot of people got involved in that. I think the other problem is that we're seeing in the Austrian theory, I guess I don't want to do it. In the Austrian theory, remember, it has been very accurate. I've watched it and been able to save my small fortune on my family's company by following the Austrian theory, the circulation credit theory. Now, there are several things. I mean, for example, there are really four main trends in the economy. There's a structural trend, which is the most powerful. And that's where you make your money, by investing in new businesses that are structurally going to be very important. There's the cyclical change, And that's what we're in now. And we go from cycle to cycle. Okay. We call where everybody sits on the sideline, a frictional stage, where companies do what? They hold cash because they don't see any opportunity. Just like if you quit a job frictionally, you say, well, I'm out of here. I don't like this boss, whatever, and you're on the sidelines. And then, of course, there's a seasonal change. The most powerful is structural. In other words, what's going to happen in the basic structure of the economy, it follows the J curve. And I often tell my students there's 3 J curves. Now, I know they want to take pictures of me, so I can't move like I used to, right? I've actually, I can move. Okay. There are 3 curves that you watch, okay? And they're all related to some extent. And you have the J curve number 1, okay? And this is the curve of knowledge. Then you have the J curve number 2, and this is the curve of technology. And then you have the J curve number 3, which all of you should be following, and that's the investment curve. Right? So what's happening is, just like investments, they go along step by step by step, right? And we go through all of this development of human knowledge. And what's happening is, it now starts hitting a point where what? Knowledge is doubling or tripling all the time. So if we measure it here, say from the Roman Empire, or actually from, say, the ancient Greeks, we're building the foundation, which later then what? Is developing which knowledge that we have today, right? We have the second curve, and that is the technology curve. And every invention leads to new inventions. Every invention opens up options. And if you take a look at it, around 1832, the thing takes off. Before 1832, economic growth was probably about 0.2%. At 1832, it hits, and suddenly it's 2%. That means there's a 10% jump in the development of technology in that 1 year. Deidre McCloskey, if you want to check that, has written extensively on that. Then this is what you guys should be involved in, the compound interest curve. And that means what? You folks should be investing at least 10% of your income. That's what I tell my students. And if you do that, and you dollar cost average, so you buy all the time, and then you buy in you buy in the top, buy in the bottom, it'll average out. And I'll guarantee all of you will be multimillionaires in gold terms. That's what I always refer to in gold terms. Because remember, gold is natural standard. Why is that? Because gold increases at the same rate as economic growth. So there's never a shortage of gold. And there's no inflation. Okay, because Mises, the economist, said there are 2 factors. One factor is the increase in cash, and the other one is the increase in stuff, in productivity. So in a way, we have deviated from that. And when we deviate from that, we get the trade cycle. And that's what we're in. There are 2 explanations for the trade cycle. One is it's monetary. That's the Austrian or the circulation credit theory. And the other one is it's natural, like the sunspot theory. Okay, I don't know if you've gone over that, but economists have said, well, it has to do with the sun. It does. There's something to it. Or there's the animal spirits theory. Oh, let's jump into the other series of stocks and drive it all the way up. Or let's start buying condos and leverage. That's the important thing. We'll borrow a lot of money and leverage it. Okay. Then there's the creative destruction theory. And that's very important in the long term, because in this curve, the technology curve, I should label this because I'll refer to these. Okay, in the technology curve, there's a theory, I think it's accurate by Schumpeter, creative destruction. how many of you have a actual dial phone in your house? Nobody, right? The electronic revolution ended the dial phone. No, I'm sure none of you have a typewriter, right? Or a slide rule. Yet those were all standard things that I had available to me when I was in college. And creative destruction meant the new product comes out and replaces the old. But the circulation credit theory is a monetary theory. And what it says is you have the expansion of money and the expansion of credit. And all of a sudden, what happens is you have overspending. I'll give an example of that. I did it this morning in class. I had a colleague, she had a house in Oakland County, $300,000 worth of equity in the house. And so credit was cheap. She thought, this is back 2008. So her and her husband decided to do what human nature says. They went on a splurge. So they traded in the house. Her husband and her were making 6 figures. So they bought a McMansion for 2 people, 3 cats, and a lizard. Okay. In other words, all of a sudden, the easy credit enabled her to buy this house for 3 cats, 2 people, a lizard. Okay. All right. Now, all of a sudden now, she goes from hardly any cost to all of a sudden now probably about a $7,000, $8,000 a month payment on the house. All right. And everything's fine. All of a sudden, the husband loses his job. Now she has a problem. Because even though she's making 6 figures, her income is hardly covering the cost of the house. And what happens? She has to lose the house, lose $300,000 worth of equity, and now she's living in an apartment. Now, our economy kind of operates the same way. Because ever since we left gold, and remember, there are several events that have happened. World War I, that disaster. Okay. And then we had the breaking of the gold standard by Mr. Nixon. And what happens is all of a sudden we give an open credit card to a bunch of spoiled brats. People go out and say, oh, we can borrow money, we'll expand, we'll go over leveraged. And what happens is the leverage gets so heavy, okay? And remember, the problem with debt is debt service. Can you service the debt? The debt service charges start coming up. And the investment made is not paying off. Suddenly, what happens, anybody in business knows, what's the key thing you want to know in your business? What's the break-even point? I used to look at the sheets and say, how much did we get a real estate company? I had 65 employees. I looked at it and I said, how much do we sell this? Well, and I could immediately calculate within a couple $1,000s what our profit or loss was on our volume. Now, what happens in the economy is this, is we take a look at this important thing called break even. I'll just abbreviate it BE. And as you add to leverage and debt, because you can borrow the money easily, oh, well, I'll just go to the bank, 2% or whatever else. What have these companies done? They borrowed the money at low rates, bought back their stock instead of investing in plant and equipment. So what they did is they drove up the price of the stock way beyond what it should be, way beyond its practical. Suddenly now interest rates start moving up. As interest rates start moving up, guess what happens? BE becomes a real problem, break even, because you're paying all this money in interest. And the economy starts to slow down, volume drops, they get closer to break even. What do? You can't increase sales, you're in a recession or the business is turning down. Okay, so what do? You start to cut cost. Okay, just like my colleague did. Harry, what should I do? Well, you should have calculated how much space you need for 2 people, 3 cats, and a lizard. Okay, I mean, it's humorous, but what has happened to a lot of people. The overexpansion occurs, which we call the Cantillon effect. And the Cantillon effect means the people who get the money first are very privileged. Wonderful. But the problem is, who are the people who get the money last? And that becomes larger and larger, and their incomes start dropping. And so what happens, they cannot buy the stuff anymore. And now the businesses start approaching break even because they have fewer sales, and they have to start going into the cleansing out phase or the recession. Now, to tell you about the Austrian theory, everybody is talking about the yield curve. Okay. The first time I learned about the yield curve, and I had, by the way, I did my bachelor's thesis on the Austrian school. And I had left Hillsdale, where I was assistant to the president. My father passed away. We came back to take over the business. And so I'm at the DAC with Bob Huber, a state senator, who was on the bank board. And he said, Hank Stoddard just said that we're going to have a recession, 1978. Okay. He said, short-term rates are above long-term rates. That was my first introduction to the yield curve. And I watched us go into that recession. Okay. And it was a very severe one. And of course, the chairman of the Fed then decided to try to put the clamp on inflation and, of course, push the interest rates through the roof. And we had a very, very severe recession. And we survived it because the company I had taken over, my brother and I took over from my father, had no debt. So we didn't have the problem of rising interest rates to keep us alive. We could cut costs. I think I was taking $100 a week out of the company, and we survived because we have more control of our cost. The building was paid for, no debt. Had we been in business, we would have had a real problem. Now, coming back to it, I had learned about the Austrian theory, and when he told me about the yield curve, I said, there's something to this yield curve. And it took me about 4 or 5 years to figure out what was going on. I still am doing the research on it. I don't have all the answers on the yield curve. But when the yield curve inverted the next time, bingo, called up my broker and I said, what should we do? I said, what do you mean? What should you do? Sell everything, get into cash, because it portends a recession coming. 2000, yield curve inverted. Now, what that means is that at the short term, people are in trouble. Now, when you're in trouble and you're trying to keep the business alive, you borrow short term because you say, if the business is alive, we got to survive. So what we do is we're going to borrow short term, thinking, guess what we'll do? We'll go into long term later. Okay. So what's happening today is that businesses and countries, especially the United States, is in real trouble. And they're into the short-term markets. Now, remember the yield curve, just to give you a thing of it. Okay. Okay, this is the interest rate. This is time. The short-term interest rate normally is below the long-term, but when it happens, it starts getting flat. It goes like this. This shows you that everybody needs cash. And what they do is they borrow short-term. Now, when they borrow short-term, they go into that market and interest rates rise. And it shows you that there's trouble coming. Okay? So I wrote that in my book, and I made it part of my lectures on the Austrian trade cycle theory. And doggone it, I got out in 2000, 2008, and I'm out now. My broker is one of my former students. I called him. I said, well, Dave, I said, the yield curve inverter, what should we do? I said, what do you mean, what should we do? Into cash, bonds, everything, out. Okay? Because what happens is this, to give you a short-term version of it. The Austrian says the expansion is unwarranted and is propelled by the increasing infusions of cash or credit. Now, I would suggest all of you get a hold of Ray Dalio's PowerPoint or whatever called The Economic Machine. Dalio understands this. I show it to my class at the beginning of the trade cycle when I'm explaining it, and I show it to at the end. I stop the film each point and I said, remember we said this. Dalio said, I remember this guy, one of the wealthiest men in America. He follows it. He explains it. It's the overexpansion fueled by increasing supplies of credit, which mean low interest rates. Well, all of a sudden you got all these low interest rates. What do? Well, you go out and you buy $1 million house for 2 people, 3 cats, and a lizard. You start investing in things that you shouldn't invest in because you think interest rates are low. They're wonderful, right? And all of a sudden there's the overexpansion. But then what begins to happen, okay? Now, we call it the Cantillon theory. I know I had some people in class this morning, so this is kind of going to be a review. Cantillon was a French economist, actually a Scottish descent, a massive crook, okay? He bankrupted a lot of poor people in France. He got away with it. Some people think he faked his own death and came to the United States, and other people think that somebody got really mad who got yinced in the whole deal and shot him, okay? Whatever. He said, the people get the money first or what? They're better off because they have the money before the prices go up. Well, okay, now where does it come from? Dalio comes from banks and basically the central bank. So the central bank says, you know, let's give this economy a kick in the butt. Let's get it going, which is what we did to so-called overcome the COVID thing. And I don't want to debate whether that was valid or not. You can make your own decision on the effectiveness of that shot or whatever. But we're going to overcome the economy. So what did we do? $6 trillion. Okay, now think of it. When Bill Clinton left office, he and Gingrich had gotten that budget down almost a balance, and some people claim a balance. Now, what does a balanced budget mean? A balanced budget means you don't have to borrow money in the capital markets. Because remember, the government now is what? They're collecting 4 and spending 6? Where does the 2 come from? Well, you can go in the capital markets, you can borrow it. You can go to Japan and you can go to China and you can say, okay, boys, how about helping us out? We'd like a loan. Or you can print the money, expand the credit. So now remember, we had to have the war. I am death on this thing of wars because wars have caused more problems in history than you can imagine. The study, I go through the history in one of my classes of inflation, the Roman Empire, the Spanish Empire, the Turkish Empire, every one of them expands the money and credit for the war and wrecks the economy, basically destroys manufacturing. The pattern is so clear. So we had the war in the Mideast for, I want to say this right, so-called weapons of mass destruction that people are still looking for. $6 trillion worth of that. The economists told Bush, look, you go into this war, and he got on TV. Bush said, oh, it's just going to be 60 billion or 70 billion bucks. That's it, right? Bush says, oh, that's great. We're going to seize the oil. We'll pay for it. Well, now it's 6 trillion. That's the Afghanistan and the whole kit and caboodle one package. Then, we're going from almost where we could have paid the debt off, and we go to 6 trillion. Then we have the COVID thing, and now the COVID thing pushes up another 6 trillion, plus all the things that Congress says, what? Why should we worry about it? We can always print the money. I heard one of them say, we'll just go to the Fed, let the Fed pay for it. That means put it on the credit card, folks. Well, that's well and good until the debt service comes. Yeah. You know, when the debt service comes, you heard the lecture before, so you're all set. The debt service comes, right? And now, suddenly, we're going to be into the point where the tax collections, the actual money we collect, is only going to pay for Social Security, Medicare, okay, part of defense, and interest. The rest of the government is running on borrowed money. Now, borrowed money means what? You're either going to have to print the money, but the problem with printing the money is this, the Cantillon effect. Because anytime you inject money into the system, even if you inject gold like the Spanish did, because remember, Spain got all this gold and silver and had a gold and silver inflation. Once you do that, you set off the Cantillon effect. What is that? Well, what that is all of a sudden, the people who get the money first, right? Because we can expand the money supply 2 ways. Give everybody $1 billion, or we can give certain people $1 billion. So it goes through the banking system, because remember, this is credit. And because remember, only 7% of transactions are covered by cash. This is credit, right? Well, who gets the money first? Well, who do the banks give the money to? Capital goods, construction, business expansion, etc. Right? So it goes into the capital goods first. Then it finally then reaches the consumer. Now, what's happening is the prices are starting to go up as this money begins to circulate. And everybody says, we have no interest. This is wonderful. Okay, 2% interest and 7% inflation or whatever it is. But all of a sudden now, what's going to happen is they're building up a debt cycle that has to be repaid and interest. And what begins to happen is interest rates, everybody grabs cash, moving to break even, the capital goods industries go down. The consumer goods industries hardly are touched. So in every recession, the big problem is going to be in what? Construction, capital investment, and the stock market. What's least going to be touched? People make toothpaste, okay? Food industries. Why? Because people will continue spending on that, but they won't continue spending on capital goods. So what will happen is, and Keynes understood this, the recession will come in the capital goods industry. Okay? So what we're looking at now is the stock market. I forget the last statistic I saw, but in general, it's gone down significantly. And it probably will go down more as companies try to seek break even. And layoffs are starting to occur. In what industry? It's social media stuff. I think it was a bubble because all those companies are laying off or going bankrupt. Any of these glory things are a bubble based on lots of credit. And so what we're looking at, folks, is this. Now, what fuels this, what really put all the gasoline on the fire was a tremendous expansion to satisfy what they thought or what may have been a COVID problem. It was an extra shot that was put in that has created, in a sense, a false prosperity, but it also did one other thing, okay? It damaged the real economy. It put a lot of people out of business, okay? These are these businesses that went out, the restaurants, the small manufacturing, et cetera, they're gone. They're not producing. So the production did what? The productivity of the economy was damaged. Because remember, you got two things going on. You got the financial economy and you got the real economy of production of goods and services. So at one time, you inflated the bubble. Both parties, if you're a Democrat or a Republican, you're equally guilty. And you damaged the productive capacity. And this is setting up, I think, what will be a very difficult time to get through. And people ask me, what should you do? Number one, deleverage. Pay off debt as fast as you can. Get out of debt. What happens is having a credit card creates all kinds of problems in an economy because you're doing uneconomic things. Now, all of you have the student income. Let me just bring it to home. I graduated from college. All my colleagues did, 1966, under the gold standard. There was no student debt. You could go through medical school, law school, undergraduate school, master's, MBA for 10 grand. The whole kit and caboodle. And gold was 35 bucks an ounce. Okay? Now, what happened was the minute you suspended the gold standard, all of a sudden you said to the federal government, wait a minute, here's the credit card. You don't have to worry about it. Uncle Fed will take care of it. You see, when you're on a gold standard, okay, you have to keep the currency, convertible into gold at a certain price, $35 an ounce. So you can't just go out and start printing because you lose your gold reserves. So what happened was governments were restraining their budgets. So they have plenty of money, and what does a politician do? Let's buy votes. Let's help students out. Okay. So they said, now I was in meetings, the administrator at Hillsdale, and what they said is, well, wait a minute, how much can the students pay? And we have this form that they fill out. You put that that figures how much your parents could pay. Okay, now then, how much can they borrow? This is the new price. In other words, the borrowing now enabled them to build college campuses with athletic facilities, look like the DAC, big towers with clock towers, all kinds of expansion, typical of the lady who bought the house for three people, whatever number of cats the list required. So they expanded. Now, when I wrote my book, I went to Central Michigan University. And one of the people asked me a question, it was a professor from economics. He said, and when one economist meets another, you think there's going to be an argument. He said, let me show you something, Prof. He says, 1971, to today, we have 40% more students, 42%. We have 42% more faculty. So how many more bureaucrats do we have? That's 100%? No, 636. So what's happening is you have this enormous amount of non-productive malinvestment. Who's paying for that? Look in the mirror. Okay, that's why I could go through college and pay $24 a credit hour, and you guys are paying $700, $800, $900. How much of that is there? Okay, what allowed that? What allowed that was that they could now, by the way, this is just the education. They could expand these programs all over the place because all you had to do is go to Uncle Fed, and Uncle Fed would bail you out. And that's what's happened again and again and again. And we have all of these programs that are all leaking. It's like a ship all leaking, building a McMansion for cats and lizards. In other words, has the quality of education changed because we have 636% more bureaucrats at Central Michigan University? No, but the cost of it has. It's the same pattern. You see, once you allow the free credit or whatever else all of a sudden what happens? You get overexpansion. And the overexpansion gets to the point that it collapses within itself because it's driving up prices, driving up interest rates. And then you have to face reality because you're not even hitting break even. And guess what? Now you got a major problem. And that's what I see we're in now, compounded by the COVID thing and the wars. Okay. Now I often get criticized, you're not patriotic and whatever else. Well, World War I, Winston Churchill, the great patriot, voted to get into that war. And he had all this wonderful things with national honor and all that. Was it worth the 750,000 young Englishmen who were killed? I don't think so. So I will tell you that these spending projects, the overexpansion, then has to be paid for. Okay? At that point, and you guys, you're paying for one of them. I'll bet you I can go around this room and get maybe $100 million worth of debt, or maybe 50 million. Okay. And you're paying for what? The overexpansion of the academic thing. What? Tons and tons and tons of overhead. And that's just in education. And that's what we've done through the whole economy. So all this stuff that's there, it's going to have to be liquidated or brought to a thing to start bringing the prices down. Now, I'll give you the last thing. I'll open up for questions because I know you've got a lot of them. My brother-in-law is a member of one of the political parties I won't mention, and he's telling me this, and he says, I'm a union guy. Yeah, okay. I said, Paul, I said, let me ask you this. I said, under the gold standard, you have more power. What do you mean? I said, well, did Adela work? And I went through all the ants. Any of these people work? No. One paycheck could support a family. I don't think any of you are planning one paycheck when you graduate from college and you get married. What's happened is that this inflationary stuff has become so heavy on the economy that now it takes two paychecks to support a house. And there's all kinds of other problems. Now, I would suggest you go to a website called Before 1971 and check out the statistics, what's happened. Okay. You can take one day of the stock market, that's fine, it goes up and down, right? 50 years, all of a sudden you see a trend. Okay. It's not political because we've had different administrations, different types of people in office. But the trend since we broke it has led to what I call the spoiled brat economy, where we're spending money we didn't have to have. We're not looking at economic efficiency. And I think we're going into a very serious downturn, as does Mr. Dalio, because the yield curve inverted. And that is a very dangerous sign. There's a cash crunch going on. Now, I'm glad to answer the questions. This thing is complicated. You probably you want to argue with me? That's fine. I'm here till tomorrow morning, so I'm ready to argue with anybody who wants to. But if you have any questions, I'd open it up for it.